Hey guys, and welcome to the Graham Strategy channel. A quick reminder to start with, I am not a financial advisor and I do not make any recommendations on what you should or should not buy or sell. In my last video we saw that the Graham portfolio reached a new all-time high of 71%. Since then it has climbed even further and recorded an even higher high. In this video we'll just take a quick look at the portfolio performance before discussing the current market situation. There are many indicators that are flashing red as if we're getting close to a market top or even a bubble. But let's start by checking out the performance of the portfolio. It's been 3 months since the last rebalancing, and looking at the performance since the beginning of the year, we can see that a major turning point was the rebalancing in the beginning of March. Since then the portfolio has gained 25%, with a year-to-date performance of 15%. Which is almost twice that of the index. And since the start of the portfolio 3 years ago, a gain of 78.6% has been achieved, with an all-time high of 81.7% 2 weeks ago. Quite a remarkable performance. But what market indicators are flashing red? Well, one of them is the well-known Buffett indicator, which shows the ratio between the US stock market value to the US gross domestic product. When the indicator is below the historical trend line, the market is considered undervalued, but when it's above, it's overvalued. And currently the ratio is at 205%, that is about 2 standard deviations from the historical trend. In most cases, when the market has been valued this high, a major correction has occurred. It is at the same level as before the dot-com crash at the beginning of the century, but not quite as during the pandemic. And it must be said that a large portion of this overvaluation comes from the big seven, that is Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. I believe many investors think that AI will change the way we value the stock market, and perhaps they're right. We'll have to wait and see. Another indicator is the S&P 500 10-year moving PE ratio. It is currently at 68.3%, above the modern era average of 20.3, which is also a sign of an overvalued stock market. Looking at the non-averaged PE ratio, we can see that the PE ratio is currently at 27.43. The big peaks during the last 3 market crashes, they occurred after the market crash, when the company profits dropped very quickly. Another indicator is the US labor statistics, and I've shown this picture before in my December video. You can see a link below, but this is an updated chart. The trend I discussed then has unfortunately not reversed. It seems like the unemployment level has bottomed out and has started to increase again. Looking at the 4 of the 5 last recessions and market crashes, not including the pandemic period, which seems to be just a temporary spike in the trend, here, we can see a typical pattern of slowly increasing unemployment before a recession, and a large market correction can be observed. One more indicator of a coming recession is when the Fed lowers its interest rates, even though it is normally as a response to a weakened economy and not a cause of the market correction. The Swedish central bank already lowered its rates earlier this month by 25 basis points. However, the Fed is more reluctant as the core inflation remains well above the target of 2%. The last indicator I want to talk about is the yield curve. An inverted yield curve, as you see here to the left, has historically been a very strong indicator of a looming recession, and the yield curve is still inverted. However, the inversion has been reduced since my December video, and the 30-year treasury is actually climbing again. And if the Fed can lower the rates slowly, we could see a more normal yield curve again, and perhaps a continued bull market. Finally, let's take a quick look at what Warren Buffett and Berkshire Hathaway are doing. Warren Buffett is one of Benjamin Graham's disciples, and thus it is of interest to see how he as a value investor is behaving under the current market conditions. Here is a chart showing how much cash Berkshire Hathaway's holding. Since June last year, they have sold stock and increased their cash position by $80 billion US. So currently they hold more than 20% of the funds in cash. Does this mean we should sell our stocks and wait for a stock market crash? I have currently no plans to sell the stocks in the Graham portfolio, and I do that in accordance with old saying, time in the market is more important than timing the market. Well, that was all for today. Stay tuned for updates on the portfolio, subscribe and hit the notification bell to receive a reminder when I release a new video. So until next time, as always, stay sharp and follow your passion.